Chapter 9, Investment Valuation. In this chapter, we will look at the topic that was introduced in Chapter 1, known as capital budgeting. This is one of the main areas within corporate finance, right? So large companies are making an investment decision that relates to a long-term project. Long-term means a period of time longer than 1 year, right? So it's a multi-year project. And we're talking about, is it worth it to put money or capital into some project? So you're going to invest a lot of money today, and in return you're hoping to be receiving some profits over several future years. So is the whole thing worth it? Are you going to make money or not? Is it going to be profitable? So to figure out if an investment opportunity is profitable, how should we calculate this whole profitability? What methods do business managers use to figure this out? And in this chapter, we're actually going to cover 4 most important methods, which very much differ from one another. And then the question is there a single right method to figure this out? Or do we use one method for some projects but not for others? And then the last question that we're going to address is, for all the different techniques that we are going to learn in this chapter, we are going to have examples in which we are asked to compare several different investment projects. So how should we compare, let's say, 2, maybe even 3 investment opportunities? Which one should we accept? Which one should we reject? So the different methods that we are learning in Chapter 9 are the net present value method, NPV, the Profitability Index method, PI, the Payback Period method, and the internal rate of return, the IRR method. These are the 4 we are gonna cover today in this lecture. The textbook has a few more approaches, but we are not gonna look at those. But there is such thing as a modified internal rate of return method, the discounted payback period method, the average accounting return method. We're not going to look at those. So we are going to skip them. Just the first 4. Let's start with the net present value approach. The idea is we are going to accept that investment project that generates profit. So how do we find profit? By definition, profit equals revenues minus costs, right? So in a typical investment project, what happens is you invest money today, which is year 0. There is no revenue that you receive right away, you invest. So maybe let's take a step back and think about some examples. In the corporate world, what would be an example of an investment project? For example, one company would like to acquire its competitor, right? So a lot of money should be spent to buy that competitor, right? But the point of that is to, kind of generate an even larger profit every year in the future, right? Or maybe an example with some restaurant chain. And this restaurant chain is considering opening a new location in some specific geographic location. Is it worth it or not? Again, there would be large upfront costs. Maybe like some building needs to be built or purchased, buying furniture, paying some interior designers, right? All of that will cost a lot of money. So there's a large upfront cost involved in any investment project. But in return, there will be money coming in the future years. So in a typical investment project, in years 1, 2, and so on, there will be revenues coming in. And of course, there will still be some miscellaneous expenses, such as paying taxes on your corporate income, paying wages to your employees, paying utility bills, all sorts of maintenance, right? All of that will still be taking place, but not on the same scale as the upfront cost in the beginning. So in a typical project, let's say it's a 4-year project, there will be a large cash outflow today. A lot of money would be spent, and we call it an investment cost or initial investment. And in the next 4 years, in this 4-year project, there would be cash inflows, right? Money received or annual profits. So to use the net present value technique, we are going to see whether overall we are going to see money coming in. If that's true, the project should be accepted. So the net present value rule says if overall money coming in from a project is greater than $0, then the project should be accepted. Let's see how the net present value technique works in this problem. You're thinking about opening a coffee shop. It will cost you $650,000 today to buy coffee machines and all other equipment. So $650,000 is a large cash outflow in year 0, right? Which is today. You estimate that your coffee sales will generate $90,000, $120,000, $170,000, and another $170,000 in the next 4 years. So one number at the end of each respective year, right? You will then sell all used equipment for an estimated $250,000 and start a different project. The proper discount rate is 8%. So this is what was given to us. We are working with a lot of numbers. It might be really helpful to start solving this problem by drawing a timeline. Under year 0 or today, you're going to put negative $650,000. At the end of the first year, you put $90,000 in profit from sales, right? Which was given. At the end of the second year, you put $120,000. At the end of the third year, you put $170,000. At the end of the fourth year, you put $170,000 again, plus another $250,000, which is how much we get when we sell all used equipment. So why don't we simplify what's going on at the end of the fourth year and replace it with the sum, $420,000. So $170K in profit from coffee sales plus $250,000 from selling all used equipment is simply $420,000 that would be coming in that year. And the question is the project worth it? Should we accept it? Should we start this coffee shop business or not? Or should we walk away from this investment opportunity? Here's how we should solve this problem. First, how much money will the project generate in the future years? Well, we already know what the future numbers look like. In year 1, it's $90,000 that would be coming in. In year 2, $120,000. In year 3, $170,000. And in year 4, $420,000. The next question is, let's calculate how much in today's dollars this project will generate. So essentially we are asked to sum up the 4 future cash inflows, right? Except the phrase in today's dollars implies that we need to take into account the whole time value of money. In other words, we need one by one to discount each of these 4 future profits and then add up their individual present values. So for example, the first year profit of $90,000 is worth a little bit less than that today. It's discounted, and we discount it by dividing 90,000 by 1 plus the 8% discount rate which is given. So we can just divide by 1.08 for simplicity. The second year's profit, $120,000, is divided by the squared 1.08, right? Because it's 2 years in the future. And so on. The third year's number is discounted back by 3 years, so the power attached to 1.08 is 3. And the fourth year profit of 420,000 is divided by 1.08 to the fourth power. Then the third step is, what's the overall profit of this entire project? Again, in today's dollars. So why are we doing everything in today's dollars? Why are we discounting? Because today is when we need to make this investment decision, right? So we need to, we cannot compare apples with oranges. We need to compare apples with apples. So today we would be investing $650,000, right? This was given. And in today's dollars, the project will bring us $629,878, right? From the previous calculation step. So the total present value of future 4 profits is $629,878. That's how much money we would get. But it will cost us $650,000 today to start this whole thing. So when you calculate the difference, right, money coming in minus money coming out, you get negative $20,122. So the overall profit is negative, which means we are going to be losing money. Now, it looks like it's a pretty complicated calculation, right? Actually, you can do the whole thing in one step. Cash flow keys. So before I show you this cash flow key solution, how would you, make a recommendation regarding this project? Because you would be losing money, you would not recommend launching this project. So you say that the project is not worth it, or you can say the project should be rejected. Now back to the cash flow keys solution. In the past, we would use the cash flow keys to find combined present value of multiple future cash flows, right? And so normally we would use $0 for cash flow 0. Not this time. This time for cash flow 0, we are going to put the initial investment amount, $650,000, and we're going to make it negative. So let me bring up my financial calculator. Let's turn it on. As always, let's start by clearing it, a full reset. Second, plus minus, enter. Let's start. I press the cash flow button. Cash flow 0 is currently set at 0 by default. We want to change it to a negative number reflecting the cash outflow in the beginning of the project, which is 650,000 negative. So I put 650,000. To make it negative, I press the plus minus key on the bottom, and then I save it by pressing enter. Down arrow key. Cash flow 01. That's the first one in the future. What is it? It's $90,000, right? I put 90,000 because it's money coming in. I leave this sign as is. In other words, it's positive. I press enter to save this number, and I press the down arrow key. F01, frequency of my first cash flow that I have just entered. It's only once in a row, and so I leave the frequency at 1, which is the default. I can then save it by pressing enter and then press the down arrow key, or I can just press the down arrow key without pressing the enter button. CO2, cash flow number 2 in the future. That's $120,000. So just like the first cash flow, I press 120,000, enter, down, and down. Next one, cash flow number 3 in the future. It's 170,000. 170,000, enter, down, down. And the last one is entered similarly. 420,000, enter, down, down. And we are done with the cash flows. There is no more cash flow number 5. Now I should tell the calculator that I want to find the net present value. So my goal is to get negative $20,122. And I'm gonna do it within the next few seconds. I press the NPV button. What's my I? I is the discount rate. It's given 8%. I press 8, enter, then down, and compute. This is my answer. Negative $20,121.99. So it's approximately negative $20,122, like I show on my slide. Okay, so in one step, you can find the net present value. One step in the financial calculator, the so-called cash flow keys. And the new thing that we were doing just now, we were entering cash flow 0 as a negative number, and everything in the future is positive. So to summarize, we were calculating the overall profit from a new investment project, and it's nothing but the project's net present value. How is net present value defined? Net present value, or NPV, is the present value of all expected future cash flows less the initial investment, because the initial investment is today, right? We don't find its present value. It's already at present. We simply subtract that large expense. The textbook defines the NPV slightly differently. It says that the NPV equals the difference between investment's market value and its cost. So what's investment's market value in our example that we just did? It's the present value of all expected future cash flows, which was $629,828. And the project's, the investment project's cost in our particular example was the initial investment of $650,000, which was given. So when you find the difference between the two, you get the NPV. And the Npv rule for making investment decisions is: you should accept an investment if the net present value is greater than $0. Otherwise, if the NPV is less than $0, the investment project should be rejected. It's not worth it. So what does a positive NPV mean? It means that we are going to receive more money in the future than the amount that we would need to invest upfront. And a negative NPV means the opposite, that we would be spending more money upfront than how much would be coming in the future. What about the NPV equal to exactly 0? In this case, we say that we are indifferent between investing or not investing, accepting the project or rejecting the project. So you can argue and say that you should probably just reject it because it's not worth the time, right? But you know, in finance, you know, for the purpose of this class, I guess, we are not considering like the effort you would be putting in, the time you would be spending on this project, and how much, you know, how you would monetize that. So we're not looking at those kind of non-monetary things, how they affect the way a project should be looked at. So we are saying that we are indifferent if the NPV is 0. In my opinion, for a big project that costs, let's say, millions of dollars or billions of dollars. What if you get the NPV of, say, $1,000? I would probably say that the project should be rejected because you only get $1,000 out of millions and millions that were invested. So again, it's one of those cases in which you can say that, well, it's kind of not worth the time and all the effort, right? But that's kind of in practice, in real life. In theory, which is what we are learning in this chapter, as long as the NPV is above $0, even if it's 1 cent, we say that the project should be accepted. Okay, let's look at the following example. You're considering two mutually exclusive projects with the following cash flows. Project A and Project B. Project A cash flows are negative $80,000 in year 0, $31,000 in years 1, 2, and 3. For Project B, the initial investment is the same, negative $8,000. The future cash flows are nothing in years 1 and 2 and $110,000 in year 3. Which project or projects should you accept if the discount rate is 8.5%? So here we need to compare two projects, right? Project A and Project B. First, there's this new phrase that we haven't come across yet in this class: mutually exclusive. What does it mean? Mutually exclusive projects versus independent projects. What are mutually exclusive projects? Mutually exclusive projects are those that cannot both happen simultaneously. You have to pick one. If both look good, pick the best one. You can only pick one, no more than one. Independent means that if both look good, accept both. So mutually exclusive projects would happen if we have some sort of limited resources. So maybe we have limited money to invest, which is only enough to invest into one project, but not two or more, right? Or maybe we have a limited amount of equipment that we could use for whatever production is involved for that new project. So we can only use that piece of equipment for one production process, but not two or more. Or maybe we have limitations with the number of employees. We only have so many people. We can only hire them for to focus on one project, but not both, and so on. With independent projects, we do not have these limitations. So if both projects look good, we will raise the money we would need to invest into both. We would hire more people, we would buy new equipment, and so on. And to summarize, when you compare the net present value for your multiple projects, if they're all above 0, then you accept only one project, the one with the highest NPV. That's if the projects are mutually exclusive projects. If the projects are instead independent, then whichever projects have the NPV above $0 should all be accepted. Now back to our two mutually exclusive projects, A and B. Let's calculate the NPV for project A. So if you do it by hand, you take negative $80,000 for year 0, and then you add $31,000 from year 1 divided by 1 plus 0.085, the discount rate, plus $31,000 from the second year, discounted back by 2 years, so the power would be 2, attached to 1 plus the discount rate, and then you add the third term, the last $31,000 at the end of the third year, discounted back by 3 years. So you divide 31,000 by 1.085 to the third power. And the answer you get, if you do this whole math by hand, is negative $825. Of course, you can do it in the financial calculator. Let me bring it up. So let's clear everything. I pressed second plus minus enter. Let's find the net present value for project A in one step using the cash flow case. So I press the cash flow button. My cash flow 0 is the initial investment entered with the negative sign. 80,000 negative, enter. Down arrow key. What's my cash flow 01? What's the first cash flow in the future? It's $31,000. 31, 3 zeros, enter, down. What's the frequency of it? So technically I could leave the frequency at 1, press the down arrow key, and then 2 more times re-enter 31,000 with the frequency of 1, or I can save myself a few seconds if right here I change the frequency to 3, because $31,000 occurs 3 times in a row, right? So I make it 3, enter, down, and there is no more cash flow 02, right? Because cash flow 02 here would mean cash flow number 4 in the future, but there are no more. So now I can proceed to computing the NPV. I press the NPV button. The display asks me to enter the interest rate, which was given. That was 8.5%. So I enter that, 8.5, enter, down, compute. Negative $825.31. Okay, so that's the NPV for project A. For project B, we have negative $80,000, and then the only cash flow that we receive in the future is $110,000 at the end of the third year. So we add it and we divide $110,000 by 1.085 to the third power. So we have discounted it back by 3 years. The answer we get is $6,120. And of course, again, we can use the financial calculator. Here we again, let's start by clearing. Second plus minus enter. Cash flow key. 80,000 negative, enter, down. So we have 0 followed by another 0 and then 110,000 in 3 years, right? So cash flow 01 is cash flow number 1 in the future, in the first year. That's $0. I press enter, I press the down arrow key. What's the frequency of that first cash flow? Well, we actually have $0 2 times in a row. So to speed things up, I can change the frequency to 2, press enter to save it, and then the down arrow key. Instead of pressing $0 as my next cash flow and leaving the frequency at 1. I could also do that, but that would take me extra few seconds. Now, cash flow 02 means cash flow in the third year, right? Because cash flow 01 was essentially $0 twice in a row. So I press 110,000, enter, down. I leave the frequency at 1 because $110,000 is only once, right? I press the down arrow key. Then NPV, my discount rate is 8.5, 8.5, enter, down, compute. $6,119.89. So I actually, rounded up to the nearest full dollar, and that's how on my slide I obtained $6,119. $120. So now if you compare projects A and B, you will see that there's actually no ambiguity here. It's very clear which one of the two projects should be the winner. It's project B. It's the only one with the net present value above $0. So that was the net present value technique. What are some disadvantages of it that we haven't come across yet? Well, technically, all future cash flows that we estimate from this project are just estimates. We are definitely going to be incorrect once we are in 1 year and 2 years and 3 years and so on. So everything is kind of, has some sort of estimation error embedded into it. And this is even more true for cash flows in more distant future. They are even less certain. Then not only are the cash flows themselves a problem, but also the discount rate has some embedded problems in it. This is something that will be covered in chapter 14 in this class. And the idea is the discount rate is something that may be changing over time. And it has to do with, the riskiness of the project and, a bunch of other things that we will see in chapter 14. Advantages of the net present value approach. It may not be clear yet why considering all future cash flows is an advantage. To jump ahead, some of the next approaches that we will look at actually ignore some cash flows. This one, the net present value approach, does not. It considers all future cash flows without ignoring any of them. It also considers the time value of money, which means all cash flows from the future are correctly discounted back to year 0. The Profitability Index technique. This is an alternative to the net present value technique. It's actually very similar to how the net present value technique works. The Profitability Index is also known as the benefit cost ratio, and it shows the value created per $1 invested. So when you invest $1 today, do you get more than $1 back in the future, exactly $1 back, or less than $1 back? Let's look at exactly the same numerical problem that we used to calculate the net present value. So again, you're thinking about opening a coffee shop. It will cost you $650,000 today to buy coffee machines and all other equipment. You estimate that your coffee sales will generate $90,000 in 1 year, $120,000 in 2 years, $170,000 in 3 and in 4 years. You will then sell all used equipment for an estimated $250,000 and start a different project. So in 4 years, the whole project will end. And that's when we essentially have 2 cash inflows. The last profit from coffee sales, $170,000, and the sales proceeds from selling all used equipment, $250,000. The proper discount rate is 8%. What is the profitability index? Is the project worth it? What we need to do is, again, calculate how many dollars do we get for each dollar invested, right? So that's kind of the idea behind the profitability index. So let's break it into 2 parts. How many dollars do we get? And then how many dollars are invested? And then we're gonna compare them. So the dollars we get from the project is, everything in the future. We need to combine it all. And just like with the net present value approach, we are doing the same exact thing. We are discounting one by one each future cash inflow, and then we are adding up the 4 individual present values. So $90,000 divided by 1.08, where 1.08 is simply 1 plus the discount rate, 8%, plus 120,000 divided by 1.08 squared, plus 170,000 divided by 1.08 cubed, plus 420,000 divided by 1.08 to the 4th power. And the sum of the 4 discounted future cash flows is $629,878, just like in the net present value approach. Next, dollars invested into the project. This number is given. Actually, yeah, let me show you that number first, $650,000. So now, how should we do it in the financial calculator? We are going to be doing it a little bit differently from what we did to use the net present value technique. This time, we are not going to include the negative $650,000 for the cash flow today. The cash flow today will be left as 0. So we are only using the future cash flows in our cash flow keys. And then we discount them at 8% and compute the NPV. So that's how we get $629,878. To find the profitability index, instead of subtracting $650,000 initial investment, we are going to divide by it. So $629,878 divided by $650,000 gives 0.97. How should 0.97 be interpreted? It means for every dollar invested today, we get back 97 cents, right? 97 cents per dollar invested. Is it good or bad? It's bad, right? We want more than $1 to come back to us for every dollar we spend today. And because that's not the case, the project should be rejected. So to summarize, we first calculate the present value of all future cash flows, and then we divide their net present value by the initial investment. And for the initial investment, we ignore the negative sign. So we kind of use, the absolute value of it. So everything is, positive numbers. And we get a profitability index that's always something that's positive. Notice how the conclusion we got in this problem is exactly the same as the conclusion when we used the net present value approach. There it was also a rejection of the project. And this is always going to be the case. So in fact, whenever the profitability index is above 1, it means we get more than $1 back per dollar invested. And that's when the project is accepted, right? Whenever that's the case, the net present value is a positive number. And a project should be rejected when your calculated profitability index is below 1, actually between 0 and 1. And that's when for every dollar you invest, you get less than $1 back. So maybe nothing back, maybe 1 cent back, right? So it's always between 0 and 1 for the rejection interval. And in this case, the net present value, if that's what you calculate instead, is always going to be a negative number. To summarize, to find the profitability index, you first calculate the present value of all expected future cash flows. And then you divide that by the initial investment. You ignore the negative sign for the initial investment. So the number you get is always going to be positive. It's always 0 or above. If it's between 0 and 1, the project is rejected. If it's above 1, it should be accepted. What about if it's exactly 1? Then it corresponds to the NPV equal to 0, and that means that we are indifferent between accepting and rejecting the project. Let's look at this next example in which we are choosing between two mutually exclusive investments, A and B. A costs $20, and rather than being given the cash flows for the next few years, we are already given the present value of all future cash flows, and that's $40. For project B, it would cost us $100 today, and the present value of all future cash flows is $150. Based on the Profitability Index rule, which one should you choose? First, the phrase mutually exclusive tells us what? It tells us that we cannot pick more than one project. So one that has the highest profitability index. Actually, the profitability index should be not only the highest, but it should also be above 1, right? Otherwise, if it's between 0 and 1, then it's not a good project. Next, let's calculate the profitability index for each project. For project A, following the calculation of the PI index, we need to take $40, the money we get in the future, and divide by $20, the money that would be invested today. We get 2. It means you double your money. For every $1 invested today, you get $2 back, right? So you get an extra dollar on every dollar invested. For project B, the profitability index is $150 received in the future, divided by $100 invested today. And that equals 1.5. So you less than double your money, you increase your money by 50%, right? For every $1 invested today, you get $1.50 back. Based on the Profitability Index rule, which is what we are asked to use in this problem, you should choose project A. That's because the profitability index is higher for project A than for project B, right? So this is how we have, compared two projects. However, you may realize that there's something much better about project B. You might actually completely disagree with the Profitability Index rule conclusion, right? So you might argue that no, project A is not the best one of the two. It's actually project B. Because if you look at the information on the cash flows, right? How much money is actually going to be made, right? The dollar bills. If you start project A, well, you make $40 after spending 20. So in other words, if you instead calculate the net present value for each project, then for project A, that would equal $40, which is the present value of all future cash flows, minus $20, which is the initial investment, and that would give you $20. So $20 is the extra cash you will make. For project B, it's $150 minus $100, which equals $50. So which project has a higher net present value? It's project B, right? You will make $50 if you accept project B, and as opposed to making only $20 if you chose to go with project A. So in this example, we have, a disagreement between the Profitability Index approach and the Net Present Value approach. The two approaches recommend us to accept the opposite investment opportunities, right? And this may or may not be the case actually. The two approaches may agree with each other, but when they would disagree is when the two projects we are choosing between are of different scale. And different scale refers to different sizes of the initial investment, right? So if you go back to our problem, then you may notice that project B is 5 times larger than project A. It requires us to invest 5 times more money than into project A. So imagine we made project A similar in size. So let's multiply $20 by 5 to make it also 100. Then if we multiply the future $40 also by 5, that will become $200. So now the net present value for project A is $200 minus $100, which equals $100. And that's more than the $50 NPV for project B. In other words, when we make projects A and B the same in their scale, then you will no longer have this disagreement between the Profitability Index approach and the Net Present Value approach. In this particular example, both approaches will tell you to go with project A. Let's summarize the disadvantages and the advantages of using the Profitability Index approach. As we just saw, we may make an incorrect investment decision when we are comparing two mutually exclusive projects that are very different in their scale, in the size of their initial investment. So we may choose the project which has the higher profitability index, but that project will bring us less money, right? Because its net present value is actually lower than for the other alternative. Advantages of the Profitability Index rule. It's easy to interpret result. For example, if your calculations give you 2, it means you double your money. For every dollar invested, you make $2. For every $100 invested, you make $200. Another advantage is it's closely related to the net present value approach. The whole discounting of future cash flows is done, which is the right way to incorporate the time value of money. Also, you may argue that when the available investment funds are limited, this is the appropriate approach to use. But in general, from the last example that we just saw, in which depending on which approach you use, the net present value approach or the profitability approach, you get contradicting results. In situations like this, you should always go with the net present value rule, because the net present value approach actually calculates the dollar bills, right? The actual cash that you make from a new project. And that's really what businesses should care about at the end of the day. The payback rule or the payback approach. How does this approach work? So this is another alternative to the net present value and the profitability index valuation methods. The idea is, do we recover our investment within so and so years? If the answer to this question is yes, then the project is worth it. Let's look at the following example. Question: how soon do you recover your initial investment? Let's say the initial investment is $100. So on our timeline, you can put minus 100 under year 0, which is today. Then in years 1, 2, 3, 4, and 5 in the future, we have $20, $40, $30, $60, and $10 coming in, respectively. Let's see. After the first year, we have recovered $20, right? After the second year, we now have 20 plus another 40. So we are at $60. We need how much more? We need another 40, right, to reach 100. So we wait another year, we earn another 30. Now we are at 20 from the first year, plus 40 from the second year, plus 30 from the third year. We are now at a total of $90. We need to recover $10 more. So $10 more, right? But if we wait a full fourth year, we're gonna earn another 60. So here we're actually considering something more realistic than treating cash flows as if they occur once on the last day of each year, right? So $60 are actually earned kind of continuously. They're slowly trickling in throughout the fourth year. So we have the first dollar coming in, the second dollar coming in, and so on. So we don't need to wait the full fourth year to get our remaining $10 back, right? To recover the remaining $10. So which fraction of the fourth year do we have to wait? Because we need only 10 out of 60, the fraction of the fourth year is 10 divided by 60, or 1/6 of the year. That's exactly 2 months. Which means after 3 full years and 2 more months, we are going to recover our $100 initial investment. And that's our payback period. The payback period in this problem is 3 years and 2 months. Now, what do we do with this result? Let's say you are a manager of this potential project, and you need to make the investment decision. Should you accept it or should you reject it? And let's say your, rule is that we're going to accept it if it pays back within 3 years. So if this project pays back within 3 years and 2 months, then it will be rejected. If, however, you are willing to wait 4 years, then because it does pay back within 4 years, the project would be accepted. If you're instead willing to wait, let's say 5 years to get your money back, then you're still going to accept the project because it pays back within 3 years and 2 months. So this cutoff is always something that needs to be given in order to use the payback rule. You're given this cutoff, this sort of limit, right? The number of years that you feel should be reasonable to wait until you get your money back. This takes us to the payback period rule for making investment decisions. Accept an investment if its payback period is less than some pre-specified number of years. This is the textbook's definition. So the payback period is what you need to calculate based on the cash flows that are given. The so-called pre-specified number of years is what you then need to compare it against. That's determined by the project manager. This is the number that's always given. That's sort of the limit, the maximum that we are willing to wait. So if you're within that maximum, then the project should be accepted. Let's look at the following example. Anna is considering adding toys to her gift shop. She estimates that the cost of inventory will be $7,500. The remodeling expenses and shelving costs are estimated at $1,800. So we have two numbers going on right away, right? If the project gets accepted. So why don't we combine 7,500 with 1,800 and just say that the initial cost is a total of 9,300. That simplifies the whole problem. Then we also know that the toy sales are expected to produce net cash inflows of $2,300, $2,900, $3,200, and $3,400 over the next 4 years, respectively. Should Anna add toys to her store if she assigns a 3-year payback period to her project? Why or why not? So this 3-year payback period that is assigned is that cutoff, that limit, the maximum that we are willing to wait. And you need to compare that to the actual payback period, which is what you need to calculate. So on our timeline, we have negative $9,300 for today, or year 0. We have $2,300 in 1 year, $2,900 in 2 years, $3,200 in 3 years, and $3,400 in 4 years. Okay, let's calculate the actual payback period. So if you wait 1 full year, we will recover $2,300, right? If you wait another year, we will recover another $2,900. So we are now at $2,300 plus $2,900 equals $5,200. We are still far away from $9,300 that would be invested, right? So let's keep adding the numbers up. Let's see how much we'll recover if we wait another full year. So we wait another 1 year, which is the 3rd year on our timeline, and that brings us another $3,200. So where are we at? $2,300 plus from the 1st year, plus $2,900 from the 2nd year, plus $3,200 from the 3rd year. We are now at $8,900. We are really close, right, to the total that needs to be recovered. So at this point, you may realize that, okay, now I need to calculate a fraction of the 4th year because it's not going to be a full 4th year. Here's where you find how much you're still missing. We need to recover a total of $9,300. That's the cash flow in year 0. And by the end of the 3rd year, you will be at $8,400. So $9,300 minus $8,400 equals $900. We need to recover $900. We are not going to wait the full 4th year over during which we will recover a lot of money, right? $3,400. Instead, we will need to wait another 900 divided by 3,400 equals 0.26 of the year. So 0.26 of the 4th year plus the first 3 full years. That's your actual payback period. 3 full years and roughly a quarter of the 4th year. So 3.26 years. And now we can make our investment decision. So the required payback period is 3 years. This is the maximum we are willing to wait. Is this project worth it? The answer should be no. It should be rejected because the actual payback period is longer than the 3-year required payback period. In this example, we are choosing between 2 projects, A and B. You will accept the project if it pays back within 3 years. We need to use the payback rule and figure out which project you should accept. Okay, so what do you know about project A and what do we know about project B? Both projects require us to spend $100 right away. Project A will generate $40 in 1 year, $60 in 2 years, $30 in 3 years, and $10 in year 4. For project B, we invest $100 today. Then we receive $30 in 1 year, $40 in 2 years, $20 in 3 years, $20 again in 4 years, $80 in 5 years, $100 in 6 years, and $200 in 7 years. Okay, based on the payback rule, which one of these two projects should you accept? What's the payback period for project A? Let's start counting. After the first year, we recover 40. After the second year, we recover another 60, and we are actually going to be exactly at $100 by the end of the second year. So the payback period for A is exactly 2 years, 2 full years. What about project B? The payback period for project B is a little bit longer. After the first year, we have recovered 30. After the second year, we are at 30 plus 40 equals 70. After the third year, we are at 30 plus 40 plus 20 equals 90. So we need 10 more to reach 100. And that's going to be exactly half a year longer, because during the fourth year, we are going to recover a total of 20, but we won't need to wait the whole year. After half a year, we will get our remaining $10. So 3.5 years, 3.5 years. Because our cutoff is 3 years, there's only one of these two projects that is acceptable, and that's project A, right? Project A is the only one that pays back within 3 years. So A should be accepted and B should be rejected. And once again, think about what might be going wrong with relying on the payback rule. So you have just said that A is better than B, right? Could that be a mistake? Take a look at project B, the cash flows that will be received in distant future that have been completely ignored when we were computing the payback period for project B. So when we were computing the payback period for project B, we were going through our cash flows in this correct order, and we stopped in the middle of the fourth year. We didn't need to look any further because that's not how the payback approach works. So we have completely ignored the huge cash inflows in 5, 6, and 7 years, right? And clearly, if project B keeps running beyond 3 years, which is our limit, it would bring significantly more money than project A, right? So let's say if these are our only two alternatives and nothing else, then I would definitely say that project B should be the winner. And essentially what I did not mention now is that by looking at all future cash flows for project B that the payback period approach has ignored, we are essentially comparing the net present values of projects A and B. Of course, we are not given the discount rate, but most probably, regardless of what the discount rate might be, when we bring back all future cash flows for project B, all the way through year 7, right? And compare the resulting NPV with that for project A, project B would become the winner. And so once again, we see that the payback period approach might result in the recommendation for one approach, but if instead we use the net present value approach, the recommendation would be for the opposite, for the other project. So the two approaches again disagree. And that happens because the higher cash flows after our cutoff, right, the required payback period, are completely ignored. So we have completely ignored $80, $100, $200 in years 5, 6, 7 for project B. Whenever the payback rule and the NPV rules contradict each other, you should go with the Npv approach, because the Npv approach considers a larger set of information. It does not ignore any potentially very high profits that would be coming in more distant future. Let's look at this example. We have 5 different projects. We're not gonna pick the best one of them. Instead, all we're gonna do is, calculate the payback period for each. For project A, we invest 100 and we get back 30, 40, 50, and 60 in the next 4 years. What's the payback period? After the first year, we have recovered 30. After the second year, 30 plus 40 equals 70. So we need 30 more, and that's going to be, a fraction of the third year. To be precise, it will take you 2.6 years to recover your $100. What about project B? What's the payback period for project B? Project B requires us to spend $200, and it will generate $40, $20, and $10 in the next 3 years. How soon do we get $200 back? Actually, we never get it back, because after the third year, we are only at 40 plus 20 plus 10, which equals 70. Now let's look at project C. We invest $200 today. In the future, we get back 40, 20, 10, and 130 in the next 4 years. What is the payback period? If you do the math, 40 plus 20 equals 60, plus another 10 equals 70, plus another 130 equals exactly 200. So after 4 full years, we will recover our initial investment. Okay, so there are no issues here. What about project D? We invest 200, and then the cash flows for years 1, 2, 3, and 4 are 100, 100, minus 200, 200. Clearly, by the end of the second year, you have fully recovered $200. But if you keep going, you lose it all, and then you recover it again by the end of the fourth year. So it looks like we have 2 payback periods, 2 years and 4 years. And that's a problem. Let's say our cutoff is 3 years, right? Right between the 2 payback periods. What do we do? On the one hand, the actual payback period of 2 years is less than the 3-year cutoff, so the project should be accepted. But on the other hand, it also does not pay back until 4 years, so it should be rejected, which means we cannot use this approach when we have multiple payback periods. It may become a problem. Now, what about the last project, project E? If we invest $50, in 1 year we get back 100, and in 2 years we'll lose $50 million, a huge amount, right? What's the payback period? Here we again have 2 payback periods. After half a year, we recover 50, but then we lose a lot of money and we never recover it, right? If we wait any longer. So the 2 payback periods here are 6 months, right? Half a year, or never. And again, what if our cutoff is, let's say, 3 years? Do we accept it or do we reject it? It's a problem. So this example illustrates additional problems with the payback rule. There may be multiple payback periods, there may be no payback periods. To summarize, there are several big issues. First, in the first example in which we had to compare 2 projects and pick the best one, we saw how cash flows after our cutoff, the required payback period, are being completely ignored. And so we are essentially biased towards shorter term projects. We are always forced to accept a project that's, a very short term project that pays back within our required payback period, right? And so that creates a problem that we may be rejecting a project which should instead be accepted. Then we also had our last example in which we saw how there may be several payback periods. Which one do we use? Because depending on which one you use, we would be either accepting or rejecting our project. Again, it becomes very unclear. Then the whole cutoff, the whole required payback period, or the so-called pre-specified payback time, where does that number come from? That's the number that's given, right? It's kind of arbitrary, because if we change it a little bit, then the whole decision would be different. For example, maybe our cutoff is 3 years, but the actual payback period is 3.5. So you would say reject. But if the arbitrary cutoff was not 3 years but 4 years, we would accept. So why 3 years? Why not 4? Right? It's kind of an arbitrary number. But a bigger problem is the way we calculate the actual payback period. We simply add up all future numbers and we stop when we reach the initial investment. So we are not doing any sort of discounting. We are completely ignoring the whole time value of money. And that's technically something that we should not be doing in finance. Advantages, it's pretty easy to use. You don't discount anything. By the way, the textbook talks about the so-called discounted payback period approach, where you add together the discounted values. Then this problem, this last problem, disadvantage, is no longer there, but everything else is still remains. Another advantage is you can say that, well, why is it a big problem that we are ignoring the time value of money? It might be okay if you are working with a small scale project for which, the whole discounting will make a difference of maybe a few cents. It's not even worth it. You can also argue in favor of ignoring cash flows in distant future, because you can say that, well, the future is uncertain. Let's just ignore everything in distant future. You can also say that, why is it a problem that we are always going to be forced to pick something short term that pays back within our required payback? You might say that, well, we are done with one quick project, we move on to the next one. Then we move on to the next one after just a few years, and so on. So this approach is biased towards liquidity. The IRR rule, the internal rate of return rule or approach. This is the fourth investment valuation approach that we are learning in Chapter 9. This is another important alternative to the net present value, the Npv approach. It's very often used in practice, actually, in the business world, and it can also be intuitively explained very easily. Let's look at the following example. You're considering an investment with the following cash flows. In year 0, you would be investing $10. Maybe it's all in millions, right? Then in year 1, your profit would be $6. In year 2, $5. In year 3, $8. And in year 4, another $8. So these are our cash flows for this 4-year investment project. What do we want to do with them? Well, let's calculate the net present value. Okay, let's start with the net present value. And then you're going to see the link between the net present value and the internal rate of return approaches. To calculate the net present value, normally we would need to also know some discount rate, right? Well, it's not given here. So let's calculate the Npv for several more or less randomly picked discount rates. Let's try 30%, 50%, and 70% for our discount rate. And then one question we're going to answer is, at which discount rate do we break even? So let's not worry about the second question yet. So we want to calculate 3 net present values, right? Separately at a different, discount rate, R. If you want to do it by hand, then the NPV would equal -10 plus 6 divided by 1 plus R, where R can be either 30% or 50% or 70%, plus 5 divided by 1 plus R squared, plus 8 divided by 1 plus R cubed, plus another 8 divided by 1 plus R to the 4th power. Or of course, you can do it in the financial calculator. Cash flow case, one step. You enter cash flow 0 as -10, cash flow 01, 6, cash flow 02, 5, cash flow 03, 8, and cash flow 04, also 8. And then when it asks you for the I, that's your rate. So that rate, you will first try 30, right? And then compute NPV. And when you try the 30% discount rate, your NPV will be $4.02. Then when you redo the whole thing and instead try the 50% discount rate, your net present value will be 17 cents. And then when you try the highest discount rate of 70%, your net present value is -$2.15. So let's illustrate it in a more visual way, what is going on and what the results mean. If we put the discount rate on the horizontal axis, right? So as we move to the right, the discount rate is increasing. And then for each discount rate, we calculate the net present value. And that's what we have along the vertical axis. So above the horizontal axis, the net present value is above $0. That's a good thing. That's when we say the project should be accepted. But if we are below the horizontal axis, that's where the net present value is below $0. And that's when we say reject the project. So when we tried the 30% discount rate, the net present value was $4.02. That's above 0, and we plot this point above the horizontal axis. Then when we instead picked a higher discount rate, 50%, the net present value dropped, and it's now only 17 cents. So close to 0, right? And then when we tried, a randomly picked even higher discount rate, 70%, that's when we saw an even smaller net present value. And in fact, it was a negative number, -$2.15. So if we tried, a few more discount rates, then we would keep adding more and more points. And all of them could be connected with this downward sloping curve. We call it the Npv profile, the net present value profile. So this downward sloping line shows that the higher the discount rate, the lower the net present value. And this is something we actually had already in chapters 5 and 6 a long time ago, where we saw how the higher the interest rate, the lower the present value, right? And present value of all future cash flows is a big part of the net present value calculation. So the net present value profile is a graphical representation of the relationship between the net present value and various discount rates. And it's a negative relationship because the line slopes down and to the right. Now, see this blinking point here. That's where this net present value profile crosses the horizontal axis. What does this point mean? It means that at this specific discount rate, and we don't know yet what it is yet, the net present value is how much? It's exactly $0. And that's the meaning of breaking even. We break even. We neither make money nor lose money. The net present value is neither positive nor negative. It's exactly 0. And we can actually figure out what this specific discount rate should be in order for us to break even. There is a way to calculate it, and if you know that trick, you will find that it's 51.2%. So in the previous calculations of the net present value, if you use 51.2% for the discount rate, the cash flow keys will give you the NPV of exactly 0. So 51.2% is the internal rate of return, the IRR. The meaning of the word internal means that this rate of return on our money every year is only based on the so-called internal information about this investment project. And that internal information is the cash flows that are given. So if we invest $10 now, we get 6 back in a year, another 5 back in 2 years, then 8, and then another 8, right? So we only used the cash flows, right? The money invested and the money that would be received to figure out what it all implies about the annual return on our money, an annual return on the $10 that would be spent now. So that's why it's called internal rate of return. So you can think of a much simpler example. Let's say you invest 10, you get 11 back in a year, and that's it. There are no more years in the future. So if you invest 10 and get 11 back in 1 year, that's obviously a 10% return. That's also the IRR. The IRR is 10%. So here it's more complicated. It's a 4-year project, right? And so it's more tricky to calculate that sort of implied, fixed annual rate of return on our money, the same return every single year for 4 years. And it turns out to be 51.2%, right? So if you invest 10, you get 6 and 5 and 8 and 8 back. And the IRR sort of connects what you spend with what you receive. So what you spend kind of equals in today's dollars what you receive across all future years. That's why the difference between the present value of all future cash inflows and the cash outflow today is 0. The NPV equals 0, right? So you kind of break even. Okay, so IRR is nothing but a discount rate, but it's a special discount rate. It's that discount rate at which, when you calculate the net present value, you get exactly $0. So at this rate, we break even. We make neither profit nor loss with our investment project. So the internal rate of return definition is it's the discount rate at which the NPV equals 0. And it's called internal because it's based entirely on the estimated cash flows for future years and the estimated required initial investment today. And it's completely independent of other sort of external things, such as the typical rate of return on this kind of projects that was, observed by other companies somewhere else. Now, okay, how do we calculate the IRR? Well, there is always the trial and error approach. It might take a while, and the idea is you try, plugging in different discount rates, and you stop when the NPV is 0. But of course, our lifesaver will be the financial calculator. Let's learn something new. If you look at the second row of our calculator, Texas Instruments BA2+, you will see the button IRR. It's right next to the NPV button. So IRR is the internal rate of return. And let's learn how we use it. What we do is, let's take out our financial calculator. Let's turn it on. Let's start by clearing everything, second, plus, minus, enter, off and on again. Imagine you're calculating the NPV. The first several steps are identical. You start by pressing the cash flow key in the second row. Cash flow 0 is the initial investment, which is -10, so you press 10 plus minus, enter, it's saved. Then you press the down arrow key. Cash flow 01, the first cash flow in the future, that's 6. 6, enter, down. What's the frequency of it? F01. The default is 1, and that's also the case in our example, because $6 is not repeated in the second year. It's only once in a row. So we leave the frequency as 1, and you can either save it by pressing enter and then you press the down arrow key, or you can immediately press the down arrow key because 1 is the default number. So I'm pressing the down arrow key. And then the same way I'm entering cash flow 02, $5, cash flow 03, $8, and cash flow 04, $8. So the second cash flow in the future is 5. I press 5, enter, down, and the frequency is again left at the default value of 1. I press the down arrow key. Cash flow 03, that's $8. 8, enter, down. Here I can speed things up a little bit and change my frequency to 2. I press 2, enter, down. And if I do this trick, then there will no longer be cash flow 04 because that was that second $8. Then normally if you're calculating the net present value, you would press the NPV button. The display will ask you what's the value for the I, which is the rate. You would enter that and press compute, right? To find the internal rate of return, you do something different. You press the IRR button and then you press compute. So after entering all cash flows where you would be pressing the NPV button, now instead you press the IRR button and compute. 51.20, right? So 51.2% per year. That's the annual return on our money, on the $10 that we would be investing in this project if we decide to accept it. Okay, let's go back to this graphical illustration of what's going on. How are we going to use this IRR approach to make our investment decision? And we are talking about in which case would we say accept the project or reject the project. Well, we have just calculated the internal rate of return. So we would be making a 51.2% return on our invested money every single year, right? If the required return, and that's the so-called external number, right? Something that is given in addition to the cash flows, right? Let's say the required return is 40%. So the required return is 40, but we are going to make a better return, 51.2% every year. So does that make our project a good one or a bad one? A good one. And so in this case, when the required return is less than the IRR that we have calculated, then we say that the project should be accepted. Otherwise, if the required return, which is a number that's given, right, is more than the IRR that we have found, then the project should be rejected. There's another way to intuitively explain this conclusion. Whenever the required return is to the left from the IRR, that's where on our graph the net present value line is above the horizontal axis, which means the net present value is above $0, which is a good thing. And instead, when the required return that's given to us is greater than the IRR that we calculate first, then that corresponds to the part of our graph where the NPV line lies below the horizontal axis, which means the net present value is negative. And that's when we say reject the project. So the internal rate of return rule, to summarize, says that a project should be accepted if the required return is less than the IRR. Otherwise, it should be rejected. And there's this very strong link between the IRR approach and the net present value approach, because whenever a project is accepted using the IRR rule, that's when the net present value of the project is positive. So that's when we also say accept when using the net present value approach. And when a project is rejected using the IRR rule, that's when it's also rejected using the NPV rule, because the NPV is below $0. So the only calculation we do to use the IRR approach is, in one step, the cash flow keys in our financial calculator. So we use the cash flow keys to find the IRR, nothing else. And the second step is we compare the IRR that we found with the required return, so-called required return, which is a number that's always given to us. So we just check whether our IRR is above or below the required return. If it's above, that's a good thing. Accept the project. Otherwise, reject it. Let's look at this example. Walmart is considering a project with an initial cost of $118,400. The project's cash inflows for years 1, 2, and 3 are $37,200, $54,600, and $46,900, respectively. Should the company accept or reject this project if it requires a 10% return? Use the IRR approach. So to solve it, remember, we only calculate one thing, the IRR, and that's done in one step in the financial calculator. So let's bring up the calculator. Let's clear everything. Second, plus, minus, enter. What are the cash flows that are given? So we press the cash flow button as if we need to find the NPV, right? $118,400. Make it negative, press enter. So we have just entered the required initial investment. Press the down arrow key. Cash flow 01 is $37,200, positive. $37,200, enter, down, and down again because it's only once in a row, so we kept the frequency at 1. Cash flow 02, the second one in the future, that's $54,600. I press 54,600, enter, down, and down again. And the third one, the last one, 46,900, enter, down, and down again. We are done with entering the cash flows. There are no more on the timeline for this project. And now I press two buttons, IRR, compute, 8.04%. So now if you look at the slide, what's the required return? So we need a 10% return, right? So maybe that's how much we need to earn in order to pay our investors, right? Who gave us the money that we are now going to be using for this large initial investment. So we need a 10% return at least. But our project will generate an 8.04% return every year. So that's not good enough. And using the IRR rule, because the required return, 10%, is greater than our internal rate of return, we would need to reject the project. Graphically, our 8.04% IRR is where the NPV line crosses the horizontal axis, and the required return of 10% is to the right of it. And that's exactly in the range in which we say that the net present value is negative, and so the project should be rejected. Now let's look at a few examples which illustrate some big problems with the internal rate of return approach. Issue number 1, non-conventional cash flows. So a project with conventional cash flows is the one in which we would need to invest money today and in return receive profits over the next several number of years. A non-conventional project is the one where we have a cash inflow today followed by cash outflows in the future. So everything is backwards. These type of non-conventional projects are also known as financing type projects as opposed to investing type. And the word financing corresponds to financing something, like taking a loan, borrowing money. Because when you take a loan, the loan amount that you receive is a cash inflow today. And in the future years, you will be slowly paying your loan amount off. So you have cash outflows in the future. So it's exactly the opposite of what you see in an investing type project. So let's look at pretty much the same problem we had on one of the earlier slides, the one that was used to explain the whole IRR approach. The only thing we are doing differently, we are switching the signs. So now in year 0, you would be receiving $10. In years 1, 2, 3, and 4, you would be paying $6, $5, $8, and $8 respectively. So I kept the dollar amounts the same, but I switched the signs. In which case should we accept or reject this project? So let's approach it the same way as the identical problem with the switched signs. Let's try randomly a few discount rates. The same ones we tried before, 30%, 50%, and 70%. And let's right away plot our resulting net present values on the same graph that we used earlier, with the discount rate along the horizontal axis and the net present value along the vertical axis. So when we try the discount rates of 30%, then 50%, then 70%, and for each compute the net present value using, for example, the cash flow case, you would get the same NPVs as we had before, but with the opposite signs. So at the 30% discount rate, the net present value is negative $4.02. At 50% discount rate, the net present value is negative 17 cents. And at the highest 70% discount rate, the net present value is positive $2.15. So we can draw a smooth curve going through these 3 points, and that's our net present value profile. However, here it's an upward sloping line, right? So everything is like an upside down mirror image of what we had before. An interesting thing is that the IRR in this case is the same as before, 51.2%. You can also check it in the financial calculator, right? So the IRR itself has not changed. So what has changed? What has changed is in which range of the required return we are going to say accept the project, and for which range we're going to say reject the project. Everything is now reversed. we are rejecting the project whenever the required return is below the IRR. That's the opposite of what the traditional IRR rule says. And we reject the project when the required return is below the IRR, because that's where the net present value is less than $0, right? Graphically, the Npv profile, the Npv line, is below the horizontal axis. And the project would be accepted if the required return is above our internal rate of return. So again, that's the opposite of what the traditional IRR rule for a traditional investment type project would say. So to review, what we mean by conventional project is the one where you invest money today and then wait to receive your profits over a number of future years. So it's an investing type project. An example of a project with non-conventional cash flows is the one that has a cash inflow today followed by cash outflows in the future. And an example of that would be taking a loan. That's where the name financing type project comes from. If you compare the graphical relationship between the discount rate and the net present value, we get sort of a mirror image for the financing type project. For the investing type project, the net present value profile is sloping down and to the right. For financing type projects, the net present value profile slopes up and to the right. So in the first case, the relationship between the discount rate and the net present value is negative. In the second case, it's positive. And for a conventional investing type project, we would say accept the project if the required return is less than the internal rate of return. Instead, for financing type projects, we would accept the project if the required return is above the internal rate of return. And so the traditional IRR rule does not work when we deal with financing type projects. That's the conclusion. And like we already had on the last couple of slides, the new rule should be rewritten completely and say something like accept the project if the IRR is less than the required return, and reject the project if the IRR is greater than the required return. Let's look at the second issue with the internal rate of return approach. This is another example of non-conventional cash flows in a project. And what's going on here is cash flows change signs more than once. So think about the following example. It's a 2-year project. In year 0, you invest $60. In year 1, you receive $155. But in year 2, you again need to spend a lot of money, and the cash flows then is negative 100. Here, the cash flows change signs 2 times. From negative to positive when we go from year 0 to year 1, and then again from positive to negative when we go from year 1 to year 2. What happens in this case is when you, again try a few different discount rates, plug them into the net present value formula or the cash flow keys in the calculator and find the IRR, and then when you connect a few results that you get, you would get a curve, but the unusual thing about it is that it crosses the horizontal axis in 2 places, right? So there is no one IRR when cash flows change signs twice. There are two IRRs when cash flows change signs twice. And the IRRs in this particular example are 25% and 33.33%. By the way, if you try this in the financial calculator, let's do it together. Let me move it here. Second plus minus enter. I've just cleared everything. Cash flow key, 60 negative, enter, down. 155, enter, down, down. 100 negative, enter, down, down. IRR, compute. What does the display say? It says IRR equals 25%. That's the first IRR. Does the financial calculator tell us what the second IRR is? No, it cannot do it. It only shows the first one of the two, but you know that there should be two. So the financial calculator is kind of, unable to handle this kind of complex problems. And for the purpose of this class, you're never going to be asked to do numerical problems like this, in which you need to find both IRRs. The only thing you should know is, in general, when cash flows switch signs twice, there will be two IRRs. And in this particular example, and in this particular example, what's going to happen is something pretty complicated. There is one range of discount rates for which the net present value is positive, and that allows us to say accept the project. That's when the discount rate is between the two internal rates of return, between 25% and 33.33%, the second IRR. And there are two ranges of the discount rate for which the project should be rejected. That's if the required return is below the first IRR, so less than 25%, or if the required return is greater than the second IRR, greater than 33.33%. So again, the traditional IRR rule does not work at all. It's something a lot more complicated. So the entire rule has to be rewritten. And guess what? Let's look at another example here, side by side. I'm keeping the same dollar amounts, but I'm switching their signs. So in year 0, the cash flow is 60. That's a cash inflow. In year 1, the cash flow is 155, but this time it's negative, a cash outflow. And then in year 2 in the future, the cash flow from this project is $100, and it's positive, a cash inflow. So I kept the dollar amounts the same as in my first example on the slide, but I switched the signs. And so it kind of became what we call a financing type project, right? Which is already what we call a non-conventional type project. And on top of that, we have another sort of interesting thing going on. The signs, the cash flows change signs 2 times, from positive to negative, going from year 0 to year 1. And then for the second time, from negative to positive, going from year 1 to year 2. So if you spend a little bit of time to, try a few discount rates and for each calculate the net present value for these cash flows, you would again get a curve that crosses the horizontal axis in 2 places. So once again, there are 2 IRRs, and they happen to be, again, which is not a coincidence, the same 25% and 33.33%, like with the first example on this slide. The only thing that changed is the entire Npv profile, the Npv line, is now flipped upside down. Now it goes down and then back up, rather than up and then down. And as a result of this sort of transformation, in the sort of graphical illustration of what's going on, as a result of that, the range of the discount rate of the required return that makes the project worth accepting is now, there are actually two ranges now. Below the first IRR, below 25%, and above the second IRR, above 33.33%. And between the IRRs is where the project would be rejected. So the project would be rejected between 25% and 33.33% for the required return, because the net present value in this case is below $0, right? So these two examples side by side illustrate this second issue with the internal rate of return approach. When we have something strange or non-conventional going on, like cash flows changing signs more than once, then we're gonna get multiple IRRs, and the traditional IRR rule stops working. In these both little examples, if you try to use the financial calculator, it will only give you the second one of the two IRRs. Turns out that if in a numerical problem the cash flows change signs 3 times, there will be 3 IRRs. If the cash flows change signs 100 times, there will be 100 IRRs. So the Npv line would be crossing the horizontal axis over and over and over again, kind of look like a wave. So things get even more complicated with the whole accept and reject regions. And now let's look at the last issue, issue number 3, mutually exclusive projects. So here we are comparing two projects. So we have $100 million, and that's all we can invest. We cannot invest into two projects, A and B, right? That's what mutually exclusive means. We have to pick one. So what do we know about each project? So let me first read what the problem says. A real estate company has $100 million that it would like to invest into a new real estate market. So maybe buying, a few buildings in some geographic region. It is choosing between two mutually exclusive projects. Market A would generate $50 million in 1 year, $40 million in 2 years, another $40 million in 2 years, $40 million in 3 years, and $30 million in 4 years. If $100 million is instead invested into market B, then in 1 year, the real estate company would generate a $20 million profit. In 2 years, it would generate a $40 million profit. In 3 years, $50 million. In 4 years, $60 million. So these are our cash flows. This is a conventional type project because we invest money today and we receive money in all future years. Okay, because these are mutually exclusive projects, we cannot invest money into both, even if both look good. So which market should the company invest $100 million into? And we want to use the internal rate of return approach. So let's try a couple of different discount rates and calculate the net present value for those separately for each project. If we try, let's say, 5% and use that as the discount rate for project A, then the net present value will be 43. It's all in $1 million, right? Instead, if we try a 50% discount rate for project A and compute the net present value, again using the cash flow case, then we get a negative $31 million net present value. So we can connect these 2 points again with a smooth curve. It slopes down and to the right. That's the net present value profile for project A. When we do the same thing for project B, at a 5% discount rate, the project B's net present value is $48 million. At 50% discount rate, project B's net present value is negative $42 million. We connect the resulting 2 points on our graph and get the net present value profile for B. So the Npv profile for A is the blue line, the Npv profile for B is the purple line. And of course, in one step, you can calculate the internal rate of return for each project. For project A, that we plotted first, the internal rate of return is 24%. For project B, that we plotted second, the internal rate of return is 21%. Now let's see how we would be making our investment decision. Here things are pretty complicated. What does the traditional IRR rule say? The traditional IRR rule would tell us that project A should be accepted if the required return, a number that's given to us, is less than the IRR for project A, which is 24%, right? So in this range between 0% and 24%, project A should be accepted. And that makes sense because the NPV line for project A lies above the horizontal axis, which means the net present value is positive. But the traditional IRR rule would also tell us that project B should be accepted if the required return is less than 21%, which is the IRR for project B. But the problem is, this implies that both projects should be accepted when the required return is less than 21%, right? We have this sort of overlap for the acceptance regions. But we cannot do that because we know that A and B are mutually exclusive. So we can't use this traditional IRR rule. We need to figure out something else. And now let's look at this graph more carefully. Let's see what's going on. See how the two NPV lines, just based on how they were plotted, they're crossing. And the crossing point means that this is where the switch occurs between accepting one project and accepting the other project. So you may realize that if the discount rate is less than this crossing point, at the level of the crossing point, then in this range of discount rates, the NPV line for project B is higher than the NPV line for project A, which means we make more profit if we choose project B than if we choose project A. So for any required return below the discount rate at which the two NPV lines cross, we should accept project B, for which the NPV line is higher, and reject project A. Now, what happens at higher levels of the required return? So now we are moving further to the right from the crossing point, right? We are increasing our discount rate. When we reach the 21% IRR for project B, until here, the NPV is higher for A than for B. So A will be accepted, B will be rejected. If you keep moving further to the right, the discount rate is increased again. We are still going to be doing the same thing. We are going to be looking at the net present value being higher for A and actually negative for B. So we are still going to accept A and reject B. But once we exceed the IRR for project A, the 24% rate, that's when both NPV lines are below the horizontal axis. So neither one of the two projects is good. They're both gonna lose, force us to lose our money. So in other words, both projects would be rejected if the net present if the discount rate, the required return that's given, is greater than the IRR for project A, the 24% rate. So see how we have three sort of ranges of the required return, and depending on where the required return is, in which range it falls, we're going to be accepting either project B or project A only, or neither. Now, a tricky question I like asking my class: in which case are we going to accept both projects? And usually the class says, oh, that's where the two lines cross, right? And my answer is always, you're forgetting that the two projects are mutually exclusive. We cannot accept both. So we can never accept both projects. Now, what's going on in the point, in the crossover point? What's going on here is the two net present values are the same for the two projects. So what's true is that if the discount rate is exactly at this crossover point, we are indifferent between which project to invest our money into, whether project A or project B. But we are not going to invest into both because they're mutually exclusive. Long story short, with mutually exclusive projects, we can never accept both projects. If both are worth it, we need to only pick one. So things got really complicated when we are looking at two crossing NPV profiles on our graph. So what should be the correct IRR decision rule in something complicated like this? Just like we saw on the graph, to summarize, we are only accepting project A if the crossover rate is less than the required return, and if the required return is also less than the IRR for project A. We would accept only project B if the required return is in the range that's below the crossover rate. We reject both A and B if the required return is in the range that's above the internal rate of return for project A. And we can never accept both projects because they're mutually exclusive. Now, a natural question here would be, so what is the crossover rate? Can we calculate it? And the answer is, in fact, we can. It's not that complicated. So let's go back to the information that was given to us. To find the crossover rate, 1 year at a time, you compute the difference between the cash flows. So for year 0, the initial investment for A is minus 100, and it's also minus 100 for project B. What's the difference between the $2 amounts? It's $0. They're the same. Now in year 1, what's the difference between $50 for project A and $20 for project B? 50 minus 20 gives 30. For year 2, you do the same thing. 40 minus 40 equals 0. For year 3, you have 40 minus 50 equals minus 10. And for the 4th year, you have 30 minus 60 equals minus 30. So how do you know for which project the cash flows should be subtracted? Well, it actually doesn't matter. Instead of doing A minus B, you can also do B minus A. The only change that you would see is that the signs would be flipped. So where you now have a positive value, you would have a negative value instead, a negative sign. But that's not going to affect our crossover rate calculation. So this is your step 1. Find the difference in the cash flows for the two projects, 1 year at a time. And be consistent, either do A minus B or B minus A. Step 2, find the IRR based on these calculated differences in the cash flows. So let's do that together. Okay, so what do we have? Let's start by clearing the calculator. Second, plus minus, enter. Off and back on. Cash flow key. Cash flow 0 is 0 from our calculations. So I press enter to save that number and the down arrow key. Cash flow 01. The difference in the cash flows between projects A and B is 30. I press 30, enter, down, and down again. Cash flow 02, that's again 0. I press enter, down, and down. Cash flow 03, we have negative 10. I press 10, plus minus, enter, down arrow, and down arrow key again. And the last cash flow number 4 in the future, is negative $30. So I press 30, plus minus, enter, down arrow, and down arrow again. I'm done. And then I press IRR compute, 11.07. So 11.07% is where the two NPV lines for projects A and B cross. This is the crossover rate. What's so special about it? That's where the two net present values are equal. So if the required return is exactly 11.07%, which project should you choose? Either one is okay to choose. It doesn't matter. They both give you the same profit. But kind of a more important implication of like what 11.07% means is that's where the switch occurs between choosing project A and choosing project B. So anything lower than 11.07%, you would choose the project with the higher NPV line. And in our example, that's project B. If the required return is slightly higher than 11.07%, that's when you switch to accepting project A instead, because the NPV is higher for project A than for project B. Here's another example on calculating the crossover rate. You're analyzing the following two mutually exclusive projects and have developed the following information. Project A would require an initial investment of $75,000, so that's a negative cash flow. Then in years 1, 2, and 3, it will generate the profits in the following amounts: $26,300, $29,500, $45,300. For project B, the required initial investment is the same, $75,000 in year 0, and the profits in the next 3 years will be $24,000, $26,900, and $51,300. Calculate the crossover rate. To solve this problem, we need to find the difference between the cash flows 1 year at a time. For example, we can do project A cash flow minus project B cash flow. Although if you do it B minus A, it wouldn't change our answer. So if we do A cash flow minus B cash flow, then for year 0 we have negative $75,000 minus the same number, which is 0. For year 1, we have $26,300 minus $24,000, which gives $2,300. For year 2, you get $2,600, and for year 3, you get negative $6,000. The second step is take these resulting differences in cash flows, use them in the cash flow keys in the financial calculator, and compute the internal rate of return. When you do that, you get 14.6%. And you can see how you would enter the numbers in the calculator. So let's do that together. Turn the calculator on. Let's start by clearing it. Second, plus minus, enter. Start by pressing the cash flow button. For year 0, we have 0. So you want to save what's on the display, which is $0, by entering enter. Then press the down arrow key. Cash flow 01. That's the first cash flow in the future. For that, we want to enter 2,300. The difference between A and B cash flows for that year. So I put 2,300. I save it by pressing enter. I press the down arrow key. The frequency of it should be kept at 1, which is the default, because we only have 2,300 once consecutively or once at all, right? So press the down arrow key once again. Cash flow 02, the second one in the future, that's 2,600. 2,600, enter, down and down again. And the last one for the third year is 6,000. Make it negative by pressing the plus minus key. Save it by pressing enter. Then press the down arrow key and press it one more time. Now, to find the internal rate of return, you press IRR and then compute. 14.60%. That's the answer. And so each project will have its own Npv profile, the line that slopes down and to the right, showing the net present value for different discount rates that are tried, and the two lines will be crossing where the discount rate is 14.6%. And to the left of it, you will pick one project. To the right of it, you will pick another project. Next example. A and B, two projects, are mutually exclusive. Which project should you accept and why? What do we know for each project? Project A would require spending $400 in year 0. In year 1, it will return $325. In year 2, it will return $200. We also know that the internal rate of return for project A is 22.17%, which is also something you can calculate yourself. And at 10% discount rate, the net present value is $60.74. For project B, cash flow 0 is negative 500. Cash flow in year 1 is 325. Cash flow in year 2 is 325 again. The IRR is 19.43%, and the net present value at 10% discount rate is $64.05. So the question again is, which project should you accept and why? Because A and B are mutually exclusive, it means we can only pick one project if both look acceptable, right? Now, we are given the IRR and we are given the net present value for each. So let's see which project would be picked based on the IRR criteria. So based on the Irr rule, you can say that the IRR is higher for project A than for project B, right? 22.17% is larger than 19.43%. And so for this reason, you can say that we make a higher return on our money, right? For every dollar invested, right? For project A. And because in both cases you make a better return than what's typical, which is 10% per year, technically both are good projects, but because they are mutually exclusive, we need to pick the one that's better, and that's project A. You can also say that project A is the winner because it has a wider range of acceptable required returns. Now let's look at which one we would choose based on the net present value rule. So both net present values are above 0, making both projects acceptable, except we need to pick one because they are mutually exclusive. So which one is better? The one with the higher net present value is better, and that's project B, right? Project B will generate an overall profit of $64.05, and project A will only generate a profit of $60.74. So based on the IRR rule, project A is the winner. Based on the Npv rule, project B is the winner. So what do? The two approaches sort of contradict each other, right? When we are applying them to comparing two competing projects. And in this case, you should always go with the net present value approach, with the recommendation that the net present value technique provides. And this was also the case on the earlier slides in this chapter, when we would try using the net present value approach and one more approach, let's say the Profitability Index approach or the Payback Period approach. And in all those cases, we would always conclude that when in doubt, when there is a conflict between the Npv approach and one other approach, then always go with the Npv approach. Why? Because that's the approach that tells you exactly how much cash you will get as a profit. So to conclude this numerical example, project B with the higher Npv should be the winner. Now let's look at the same exact problem, but we are only changing the wording slightly. A and B are no longer mutually exclusive. They are now independent. What does independence mean? It means if both projects happen to be acceptable, we will accept them both. Again, let's make our decision based on the IRR criteria. The IRR rule says a project should be accepted if the required return, which is 10% in this problem, is less than the IRR, and both IRRs are above 10%, which makes both projects A and B acceptable. And because they are independent, we are independently making our decision regarding each project. So we are going to choose them both A and B. Now the net present value rule. What does the rule say? A project should be accepted if the net present value is above $0, right? Is it? Yes. $60.74 for project A, that's above $0. And for project B, the Npv is $64.05. Again, a positive number. So once again, if we make our decision on each project independently, we would be accepting both A and B. So here, we didn't have any sort of contradiction between the two approaches. They agree, and it's going to be a clear decision to make. We're going to accept both projects in this situation. Let's summarize the disadvantages and the advantages of the internal rate of return approach. We saw that the IRR rule stops working when we are dealing with non-conventional cash flows. For example, a financing type project where cash inflow is followed by cash outflows, rather than the other way around, which is what investing type projects are. And another example of non-conventional cash flows is when cash flows change signs more than once. So once would be you invest money today, that's a negative cash flow, right? And you receive money in all future years. That's a positive cash flow for each year. So there is one sign change. But here we're talking about more than once. So from minus to plus, and then at some point from plus to minus again. And in this case, what happens? We have multiple cash flow, multiple IRRs. So the number of IRRs equals the number of times cash flows change signs. And the problem with that is that we're not going to have one range of required return for which the project is acceptable. There will be multiple such ranges. The second big problem is we cannot use the traditional IRR rule when we need to pick one project between several alternatives. So when we deal with mutually exclusive projects, again, we need to completely rewrite our IRR rule so it can fit a situation like this with comparing mutually exclusive projects. The advantage of the IRR rule is that it's really strongly kind of linked to the net present value calculation. So we are considering all cash flows. Nothing is being ignored, which was the case with the payback period approach, right? Everything is discounted back to time zero, so the whole time value of money is taken into account. The book also says that the IRR rule is easy to understand and communicate. I guess all you do is calculate the IRR for your project, and then you simply compare it to what's required. If it's better, higher than what's required, then the project should be accepted. Then you can also say that one advantage is if you calculate your IRR and it's something very large, let's say 70%, you can be pretty sure that whatever the typical return is for projects like these ones, maybe done by other companies, your IRR covers that. So you're better than anything else that's typical with this kind of projects. Let's summarize chapter 9. We looked at 4 completely different techniques to make a decision on a multi-year project, whether it should be accepted or rejected. So that's also called capital budgeting decisions. For the net present value approach, what we were calculating is the dollar amount, the profit. That was in dollars. And we say that the project should be accepted if the net present value is above $0. Notice how the what we are calculating is completely different for the 4 approaches. For the profitability index, we compute an index. It's just a ratio. It doesn't really have units. So you can say that it's for every dollar invested, how many dollars you get back. But it's really kind of a ratio which doesn't have units. And the rule here is if the profitability index is greater than 1, then the project should be accepted. Because greater than 1 means for every dollar invested, you make more than $1 back. The payback period approach instead calculates time, how many years it takes you to get your invested money back. And the rule says if the payback period is below the required payback period, something that the manager decided that is a reasonable amount of years to wait, then that project should be accepted. And finally, the internal rate of return approach. What we calculate is a discount rate. It's in percent. And it's a special discount rate that makes us break even. The NPV is exactly equal to 0. And the rule is you calculate the IRR and then you simply compare it with what's required for this project. If it's higher than what's required, then the project should be accepted. Just very quickly, you can do, a lot of these things in Excel. It actually speeds things up a lot. You can find a built-in Npv function in Excel, which you can use for the net present value and also for the profitability index. And there's also a built-in function to find the IRR, like in a matter of seconds. So if you're interested in this, come up to me after class and I'll explain, very quickly. It will probably take me a minute or two to explain to you how these built-in functions work. I can just show you an example. We can make something up and then see how the math would work. When you are applying different techniques like the Npv approach, the profitability index approach, and when they disagree with each other, always go with the net present value approach. So this was coming up over and over again throughout the slides. We had it I think 4 times at least in different contexts. Then in real life, which valuation method is used in the real world? A survey in 1999 of different companies showed that large firms prefer using the IRR or the net present value approaches. Small firms like using the payback period, and that probably makes sense because for small firms, they don't deal with large amounts of money. They're dealing with hundreds of dollars, thousands of dollars, right? And then the payback period, which completely ignores discounting, is good enough for small firms, where discounting would make a difference of just maybe a few cents. Let's do a couple of summarizing examples. Let's say John has analyzed 2 mutually exclusive projects of similar size and has compiled the following information based on his analysis. Both projects have 3-year lives. So you can imagine year 0 when the money gets invested, year 1, year 2, year 3, right? Project A, Project B. For Project A, the net present value is $81,406. For Project B, it's $82,909. The payback period for Project A is 2.48 years. For Project B, it's 2.31 years. The required return for Project A is 11.5%. For Project B, it's 12%. John has been asked for his best recommendation given this information. His recommendation should be to accept ... because ... So which project should be accepted? See how we have the net present value approach and the payback period approach going on in this problem. Remember, sometimes they may give conflicting recommendations or conclusions, right? And so we know that when in doubt, we should always go with the Npv approach. So why don't we just look at the net present values? Because the projects are mutually exclusive, we cannot accept both A and B, even though both of their net present values are above $0. So we can only pick the better one, and that's Project B. So the answer is, the recommendation would be to accept Project B because it has a higher net present value. That's it, as simple as that. Now, what if we change the wording and say that projects A and B are independent? Would that change our result? The answer is yes. Independence means we accept all projects which are good. Both A and B look good based on their net present values because both net present values are positive. So in this case, we are going to accept both projects because they both have their net present values above $0. So be careful with the wording. It can completely change your conclusion. Let's do another sort of very comprehensive problem. Here we have all 4 approaches, right, used in one problem: the net present value, the profitability index, the payback period, and the IRR. So let's start from the beginning. You're considering a project with conventional cash flows and the following characteristics. The NPV equals $987. The profitability index equals 1.04. The payback period is 2.98 years, and the IRR is 11.63%. Which of the following are correct? We have 4 items. A. The discount rate used in computing the NPV was less than 11.63%. Is this correct? It is correct, because 11.63% in our problem was the IRR. We also know that we are dealing with conventional cash flows. So it's a typical investment type project. And for a typical project, it's accepted when, meaning the NPV is positive, and it is, right? It's $987, when the required return is less than the IRR. And so the discount rate being less than 11.63% must be correct. B. The discounted future cash flows cover the initial investment after exactly 2.98 years. So 2.98 years was the payback period, right? This sentence is actually incorrect. There's one word that makes it wrong, and that's the word discounted. It should not be here. We do not discount future cash flows when we add them up to find how long it takes us to get our money back. We simply add them up, right? So if we get rid of the word discounted, then the statement B would be also correct. Let's look at the statement C. The discount rate used in the computation of the profitability index was 11.63%. This is wrong. 11.63% is the IRR. It means that at this rate we break even. The NPV is 0. The NPV being 0 also implies that the profitability index is 1. Is it 1? No. We are given 1.04. So the math doesn't add up. So the discount rate used in the computation of the PI index must have been less than 11.63%. And actually, it's very similar to statement A, the first one. We already figured this out in statement A, where we figured out that the discount rate must have been below 11.63%. And so A and C are kind of similar. Because whenever the discount rate is below the IRR, that's when the net present value is positive, like given to us, and the profitability index is above 1, and it is above 1. And the final statement is statement D. This project should be accepted as the IRR exceeds the required return. So this is kind of the definition of the IRR rule. And we know that we are dealing with conventional cash flows, so we can apply the traditional IRR rule. And we already know from parts A and C that the discount rate is, the required discount rate is below our IRR. So this statement is correct.